Namaste, good morning. The session which bridges the last part of our discussion before going into various types of assessment of entities. Hopefully, from tomorrow we are meeting physically. I hope the rains have stopped, and whoever possible, we will be meeting physically from tomorrow. Today, the focus is on this small arena which is important for going into assessment of entities. That arena is a part of chapter 6a deduction, a part of chapter 6a. Basically, like how we saw exemptions of capital gains. Exemptions of capital gains we broadly divided into two: for individuals or non-business domestic exemption, though individuals who are carrying on business can claim it, but basically, and business oriented exemptions under section 54. We did it like that. Similarly, our chapter 6a deduction is or can also be divided into two: deductions which are available mostly for a non-business assessee or even for individuals and HUF carrying on business, and business oriented deductions. Deductions which a business assessee can claim. In that, the major part is section 80I. The major part which is being spoken about is section 80I. Okay, where we are speaking more about business oriented deductions. Section 80I, we are speaking more about business oriented deductions. Now, coming to the traditional aspect of chapter 6a deduction. Okay, coming to the traditional aspect of chapter 6a deduction. If you remember chapter 6a deductions, okay, the first part is expenses or outflow oriented deductions. Okay, the first part is this, which speaks from 80C to 80G. Expenses or outflow oriented deductions. In this, what is important or what the business assessee can claim is 80G donations, which even available for business or profession, people carrying on business or profession. 80GGB and GGC, donation to a recognized political party, which also a business assessee can claim. 80GGB is for companies, GGC is for non-corporate assessees. So this can be claimed by them, by a business assessee as well, in the expenses or outflow oriented deductions. Otherwise, this is majorly for individuals. When we do assessment of individuals, we will cover that. The second part is income or inflow oriented deductions. The second part is when you earn something, What are all the deductions you can claim? Income or inflow oriented deductions. This gets some importance. In that, it is majorly for business associates. Only the last three sections, which are 80 TTA, interest on savings deposit, 80 TTB, interest on deposit for senior citizens, 80U, where assessee is suffering from a physical disability for individuals. Except these three, almost everything is for business associates. Almost everything. Royalty, for patents, for copyrights. Cooperative societies will have ATP. And whatever we are going to see in today's class, which is basically ATI for promotion of various sectors. When I write ATI, it starts from I, IA, IB and goes on. Okay. This is one section which we are going to see. 80JJAA for employment generation. Okay. Promoting people to promoting organizations to employ people. Employment generation is the key factor of 80JJAA. Those are all the things we are going to cover. So coming back, of course, 80G can be claimed, 80GGB can be claimed. We will see it along with the assessment of individuals. There it will be discussed in detail, but we know this can be claimed. Here our focus is that income-oriented deductions, which the assessee is eligible to claim, especially section 80I. In that perspective only, I am going to open up and see. I go back to the story which I was telling you how the changes happened over a period. 80s, the famous deduction was H, 80H, and now 80H is not at all there. Early 90s, when Dr. Manmohan Singh took over, it was exemptions, section 10 oriented exemptions. Later, when Mr. P. Chidambaram again became the finance minister, 80I started. In the fag end of his career, somewhere around 2014, 11-12 onwards, 2011-12 onwards, 35 AD is the section which we know. Investment-based incentive scheme. You invest and earn the deduction. You invest and for the investment you can claim the deduction. So, from a profit-oriented or income-oriented approach, we went to investment-oriented mode. Having said this, I also want to make you all clear that these three sections are as of now coexisting to a part. There is a small integration part in all the sections. So there will be wordings in the section in such a sense, it will say, if you claim deduction under this section, you cannot claim exemption under 10AA or expenditure under 35A. Okay, I am repeating. If you are claiming a benefit under this section, you cannot claim other type of benefit in any other section. Those words are there as part of this chapters. Okay, right. Why am I taking this time? To make you understand that we call all this as sunset provision. We call this as sunset provisions. Abdina, these are going to slowly fade away. All section 80Is are nearly at the end of the claiming period. Maybe some like 80 IBA might continue for some time. But almost all section 80Is are in the fag end. Why? I told you from 2011-12, our whole approach shifted from a profit or an income oriented deduction to an investment oriented incentive. So our approach got a shift. When our approach shifted in these sections, the importance started coming down. These sections were for a period of 10 years, 15 years, 20 years, like that. So the last 3 years, the last 4 years will only be live now. Major part of the years would have been over. That is why I am saying that this is known as the sunset provisions. Going to go off, going to fade away. Sunset provisions. From our examination perspective, I am loud and clear to all of you, loud and clear, the least of the importance to 80Is. The least of the importance, please. The reason being, normally our examination doesn't focus on sunset provisions. Normally our examinations doesn't focus on sunset provisions because there is no point as these are going to go off. There is no point. The business should have been started on or before 31/3/2018. For your assessment year, if you have started business in that year, you can claim deduction, that's all. They are now not going to ask you what are all the conditionalities, because that conditionalities are no more as in this year. If somebody commences business, they cannot anyhow claim 80Is. So you are not going to advise on the conditionalities. Sir, these are all the conditions upon which you should claim. You are not going to advise them. Maximum you can say, sir, 100% of profits can be claimed. And that is the importance this section gives. From the examination perspective, this is also, for the exam also, this is sunset. This is not going to be of any great importance compared to the, and rarely they touch upon amendments. The maximum amendment will be extension by 1 year, like that. And Finance Act 2020 has not touched upon 80Is at all, which means they are allowing it to go off. So these sections are slightly fade away sections. These became dynamic. I told you these were started to getting popular from late 90s and early 2000 till 2011-12, where the shift happened, but parallelly this was existing. So you will find that the case laws are more than theories. The case law of ATI will be more than the theory of ATI. Reason is very simple. Now only the judgments will come for those years. Of course, true, the judgment is coming in the year when the sections are faded. But case laws gets importance now because now only judgment comes. In the last 4-5 papers, only because of an amendment in 1 year, there was a question. Otherwise, I don't find questions in this. Why I am telling you is, I am only going to give you what you should know here. Condensed theory is sufficient here. And this is more than sufficient. Trust me, this is more than sufficient for you to answer any question on this, which I tell you will be very apparent, very clear. Let's go ahead and see. No doubt these are chapter 6A deductions. Okay, it is forming part of 6A deductions, but it is for business associates. Deductions are offered with the intention of majorly promoting infrastructure facility, but I won't call only infrastructure. There are other manufacturing activities which are being carried on, popularly known as tax holiday deductions. What is tax holiday? For the next 10 years you can claim. That is known as tax holiday. For the next 10 years, you can claim the deduction that is popularly known as tax holiday. When we analyze section 10, we will come across similar provision, 10AA especially. Fag end of the class, we will analyze that also. Okay, we are also aware of 35D. An assessee opting to claim for availing benefit under 35D cannot claim deduction. In short, assessee cannot get dual benefits. For example, housing sector. Both the 35AD covers and 80IBA covers. Both 35AD and 80IBA, I cannot avail both. I cannot avail both. I can avail only one. And this is the most important. All these deductions are available only if the assessee files the return before the due date of filing returns. These deductions cannot be claimed by the assessee if he files a belated return. These deductions can be claimed only if the returns, these deductions can be claimed only if the return is filed on or before 31st October or its extended dates as it is. In this, the first section, 80IA, is purely for developing infrastructure facilities. Repeating, in this, the first section, 80IA, is for developing infrastructure facility. What is infrastructure facility? Roads, power, telecommunication, dam, like that, water. Infrastructure facility, especially given for roads. You can understand, probably for the millennial generation, they would have heard about it. Whenever we talk about roads, highways, for all of us, one person should come to our mind, Sri Atal Bihari Vajpayee. He is the one who started dreaming of connecting India by roads by giving quality roads. So all the highways, Trichy, Bangalore, all the other sectors, okay, the roads started developing during his tenure, 2001 to 2006, or during that phase. Remember, that is why 80IA was very popular at that time, because these were given the benefit. Okay, so developing, operating and maintenance of any infrastructure facility which commenced, okay, after 95 but before 31/3/2017. So now the 10-year period is alive. Probably we are in the 5th or 6th year. But now if an industry starts in this, you cannot get the benefit. You can get it under 35AD. That's why he said they will not ask you what are all the conditions upon which 80IA can be availed, because there is no point. That conditions are over. Those conditions should have been satisfied, not now. In 2017 it should have been satisfied. 2015 it should have been satisfied. That is why I say that there is a big shift from the examination perspective of it. So developing, operating and maintaining infrastructure facility, all types of infrastructure facility, roads, railways, electricity, telecommunication, like that. Power undertaking, generation and distribution, again up to 2017. If you start a power plant, Reliance and many other companies, if you are a generator come distributor of power, or you were, now you undertake substantial renovation and modernization. Substantial renovation and modernization of your power sector. Reconstruction or revival of power generating plant. Reconstruction or renovation of power generation plant. All these things are considered as infrastructure. What is the quantum of deduction? 100% of the profits, whatever profits derived from such business for 10 consecutive assessment year. First 10 years are wait. In case of infrastructure facility of road, bridges, railway or highway projects, 10 assessment year out of the first 20 years, whereas other power sector, telecommunication and all, 10 assessment year out of the first 15 years. For roads, bridges, railways, highway projects, irrigation projects, out of first 20 years, 10 years. For power sector, out of first 15 years, 10 years. You can choose, but it should be consecutive. It cannot be 1, 5, 7 like that. If you start from 1, it will go on for 10 years. Or you can leave the first 2, 3 years and start from the 4th year and go for 10 years. It should be 10 consecutive years out of the first 15 or 20 years of operation. Normally, the initial period might be a loss-oriented year. Normally, the first 2 years might be loss. And if you have any other business, claim it along with that. Normally, the initial period will be loss. So, if you have any other business, we can claim it along with that. and then from the year of profit, if we start, it will be more beneficial. That's why first 10 consecutive years out of the first 20 years or 15 years, as the case may be. As I have told you, this year, from your perspective, from your examination angle, if they give you profit of a eligible business under 80 IA 40 lakhs, you are going to write deduction under section 80 IA 40 lakhs. You are not going to talk about conditions. For 35 AD, conditions are also important. It should be a new business. What is new business should be defined. Okay. And it should have commenced during or any past period expenditure can be accumulated and claimed. Business loss cannot be like that. Conditions are they specified business. Here, conditions are not going to be important at all because business has already started, not in your assessment year or not even in the immediate things. Business has already started. You are just going to claim the deduction. Okay. Two things I am talking about is one, understanding the section. Second, as a student, know what you should know. 100% can be claimed. Section 80 IAB, development of SEZ. What is this? Development of SEZ. It is not a unit in SEZ I am speaking about. I am not speaking about a unit which is located in a special economic zone. I am saying this is for the persons who are constructing the tidal park. It is for persons who are constructing the Tamram, okay, SEZ. Okay, it is for them. Okay, and not for units located there. For them, there is another thing will come. This is for development of economic, special economic zone. You will wonder what type of income they will get. As a developer of special economic zone, what type of income I will get? Rent, royalty, if that is the agreement between the tenant and me. Any allied income. Any allied income. I let out parking lot. I let out parking lot and earn income. That will also come here, my dear friends. Providing parking facility, allied, will also come here. What am I doing? I am developing a special economic zone. I am not a unit in a special economic zone. So it should have been started before 31/3/2017. 100% of profits earned 10 out of 15 years. 100% of profits earned 10 out of 15 years. So in your year, you are only going to, if there is an income from this particular segment, you are going to claim deduction. Out of the deductions, this is of recent importance. You can see the period. Okay, so very closer to our assessment here, this business should have commenced. Eligible startups. Sir, have we studied eligible startups? Yes. Yes. 54 GB. Sell your house property. Invest it in an eligible startup. We have studied this section. very recently, Section 54 GB, sell your house property and invest in the shares. You should own at least 25% of the share capital of that company, and that company should have invested your money in plant and machinery. Okay, eligible startup engaged in innovation, development or improvement of products, services and process, and most importantly, scalable business model with a high potential for employment generation. That is one factor which I am giving it as eligible startup. It should generate employment, then I am ready to recognize it. Okay, here the deduction period is shorter, 100% of the profits for 3 consecutive years out of the first 10 years. 100% of the profits for 3 consecutive years out of the first 10 years. ATIA has only 3 business models. ATIA has 3 things. One, the main ATIA, which talks about infrastructure, power generation. The next section talks about development of SEZ. The third section talks about eligible startups. Eligible startups. Can you write it quickly in the notebook? Quickly, a small note so that further small notes so that you are very clear. ATIA. ATIA. Infrastructure facility. Infrastructure facility. Under that, 100% of the profits for 10 consecutive years out of 20 years. 100% of profits for 10 consecutive years, for 10 consecutive years out of 15 years. For 10 consecutive years out of 15 years, full stop. However, for roads, railways and water projects, 10 out of 20. For roads, railways and water projects, 10 out of 20. Just it will be 2 columns. Here the section number, here the provision. ATIAB. Developing SEZ. Developing SEZ hyphen all direct and indirect incomes. All direct and indirect incomes. Ten out of 15 years. ATIAC. ATIAC. Eligible startups, which is majorly employment generator oriented, innovation, etc. Okay, more for technology sector. ATIAC. 100% of profits, 3 out of 10 years. 3 out of 10 years. Here also conditions doesn't matter, my dear friends, because till 31/3/21 only. Now walking into next one, which is section IB, 80 IB. If 80 IA is in the middle, that is 2018-17, it should have been started. Now we are in the middle of the years. 80 IB, you are in the tip. You are the fag end of it. You are in the tip of everything. Okay? You can see the business should have commenced before 31/3/2012. It should have commenced in 11/12, like that. 80 IB. Deduction for not specified but specific business. Deduction for specific business, industrial undertaking, especially SSI in Jammu and Kashmir. It is an industrial undertaking which is in the manufacturing sector in the state of Jammu and Kashmir. Okay, you are literally in the fag end of claiming this exemption. 100% of the profits for the first 5 years and 25% in case of company 30. So let's talk about 30 only, and thereafter you can claim 30%. 100% for the first 5 years and 30% for the rest of the period. If it is a non-corporate assessee, only 25%. You are almost getting over with it. Almost getting over with it. Mineral oil, the period is the same. 7 consecutive assessment years, 100% of the profits. Almost this is over, mineral oil. Now mineral oil has better deductions. We already saw 32, 33 ABA for oil and production of oil and deposit based deduction. Processing, preservation and packaging of fruits, vegetables and meat. We have it in 35 AD. Storage of agricultural produce, cold storage facility, preservation facility. Though a country which is surplus in the production of agricultural products, but unfortunately there is a crisis because we are unable to store this product. The perishability of the product is much higher than its storage capacity. So if somebody is able to develop a facility, previously I was giving them 80 IB, now they will prefer 35 AD. Why? Because all the godown cost, all the amount I invest on equipments can be claimed as deduction in year 1 itself. Investment based incentive. So that is more beneficial anyhow. This is again like 80 IB, 100% for first 5 years, thereafter 30%. Thereafter 30%. Trust me, there were 26 business items. All of them have faded. Only 3 of them are active. That too in the fag end. Slowly this will go off. They'll announce a date and say that from this date, this section doesn't apply. You have better sections to claim the benefit. In your notebook, 80 IB here, 80 IB here, and in the next aspect, 80 IB in the next aspect, deduction for industry in J and K, deductions for industry in J and K, Jammu and Kashmir, slash deduction for preservation of perishables. Deductions for industry in J and K slash deduction for preservation of perishables. Hyphen, first 5 years 100%, next 5 years 30%. First 5 years 100%, next 5 years 30%, open bracket, 25% in case of non-corporate assessee. 25% in case of non-corporate assessee. Next is 80 next line, for mineral oils 100% for the first 7 years. 100% for the first 7 years. Like how you saw 80 IAC startup, this is also 80 IBA developing and building of affordable housing projects. This is our Prime Minister's dream of housing for all. Based upon this, it came affordable housing project. It is not any year or project. And the project, whatever profit of that project is exempt, is allowed as deduction. 100% of profits derived from such project. Remember, 35 AD also has affordable housing projects. So you now can recollect, if assessee is claiming 35 AD, he cannot claim 80 IB. If he is claiming 80 IB, he cannot claim 35 AD. The northeastern frontiers got importance when Dr. Manmohan Singh was the Prime Minister. The northeastern part of the country. So, two exemptions were given for northeastern, deductions were given. The first is section 80IC, specifically for Himachal Pradesh and Uttaranchal. You can see the dates. Almost over. Almost over. We are the, probably this is the last year. 100% for the first 5 years, 30% for the next 5 years, or 25%. And then the next section also gave deduction for northeastern states, which is up to April 17, you can say, up to 31/3/17, 100% for the first 10 years. all industries which are located in Arunachal Pradesh, Assam, Manipur, Meghalaya, Mizoram, Nagaland, all northeastern frontiers. Read through this once. 88. Read through this once. I am again telling you, because if you take the study material and start analyzing, it will be some 25 pages, and you will wonder why we have not covered. Actually, you know those things. In all these cases, I will state that it should be a new business. And if I ask you what is a new business, you can recollect the two conditions which we have to say for new business. It should not be formed by splitting up of an existing undertaking, and 80% of the plant and machinery should be new. Audit being mandatory. These things you are very much aware, so nothing new to you. In all these sections, this condition will be again and again written, and old provisions will also be there. But in our material itself, after all these things, they would have given a condensed table, summary table, and that is what they mean, that if you read it, it's enough. Okay, so never worry about these sections absolutely losing its importance, because these are sunset provisions, and in your year you need not, there is no condition to be fulfilled. You cannot ask 35 AD, you can be asked a theory question on conditions. Here maximum is whether I can claim 100%, and they will give you so much and such business which is eligible under such and such 100%, 30% or 100%, whatever it is. That can only be part of your question. Number 2. This is number 1. And the second part, as I said in the front itself, now only in these sections judgments are coming. Though the sections is slightly fading away, judgments are coming now only. So in that manner, there can be a case law question, rare, but there can be a case law question. Some of the majority of the case laws you will be able to answer in the straight away in the classroom. Okay. Chetak Enterprises Private Limited. Sir, can you tell me about what is the one phrase which I asked you to remember in the case of succession of business? In the case of succession of a business, what is the one phrase which I asked you to remember? Can somebody recollect?
Always, whatever happens, you're supposed to consider all events as if the succession did not happen.
Very good. Provisions will be applicable to the transferee entity as it would have applied to the transferor entity had the succession not taken place. Same, sir. This first case law is one other proof. The firm entered into agreement with the government for construction of road and collection of toll. Firm was converted into a company, duly intimated the authorities and got fresh code. The issue under consideration is whether the relevant criteria laid down in section 80IA are fulfilled by the company which was succeeded by a firm upon its conversion for claim of deduction thereunder. You have converted. Conditions are only fulfilled by the firm, not by the company. It should be new. 80% of the plant and machinery should be new. All these were fulfilled by the firm. After 5 years, the firm got converted into a company. Can the company now claim 80IA? Remember, as our friend was saying, provisions are applicable to transferee entity as it would have applied to the transferor entity, as if the succession as not a agreement was initially executing between the firm and the government, but with a clear understanding that as and when the firm is converted into a company, the name of the company so executed be recorded, recognized. Number agreement if you look into the answer, such and such party with its assignees, liquidators, successor, inheritors. This means, this term, the party means not only the person I am mentioning, but also all its forms it can take. Assessing company qualified for deduction, being an enterprise carrying on the stated business pertaining to and owned by a company registered in India. So you cannot deny when when the firm has fulfilled the condition, that firm has only succeeded into a company. So the assessee includes its successors and assignees. In all the agreement you can see this. Hence 80IA can be claimed. CCIL, Container Corporation of India, CONCOR, Container Corporation or CCIL. What are they doing? Inland container depot, the customs port, airport or harbor, அதுக்குள்ள handle பண்ற inland container depot. Is it an infrastructure facility? Will it also qualify under 80IA? Inland infrastructure facility included inland port. Considering the nature of work such as customs clearance carried out at the inland container depot, it can be considered as an inland guide. Hence, CONCOR can claim the deduction under 80IA. It's a specific judgment for that particular organization, not on an overall basis. It's a specific judgment because their major object is handling of cargo and transporting the cargo internally, externally in the port and harbor. That's why. Interesting case law. The company entered into agreement with the Road Transport Corporation. The company entered into an agreement with the Road Transport Corporation for construction of roads and said they are claiming deduction under section 80IA. Assessing officer disallowed the exemption, stating you have not entered into agreement with the government. You have not entered an agreement with the government. You have entered an agreement with only a corporation. So I will not allow the exemption. I will not allow the exemption. The court took the stand. The corporation is owned by the government. Number State Transport Corporation. It is owned by the government. Entering into an agreement with the corporation is deemed to have been entered with the government, so it should be allowed. Assessee enters into an agreement with the Gujarat State Road Development Corporation for an infrastructure development project, which is eligible under 80IA. Even though as per the regulation contained therein, the agreement has to be entered with the central or state government or local authority. Held by High Court, Assessee has entered into an agreement with a government agency which is constituted by the state government for the purpose of executing road development projects. It is eligible to claim deduction under 80IA. We cannot deny that. Swarnagiri Wire Installations Private Limited. Swarnagiri Wire Installations Private Limited. We all know, understand this case practically. 80IA, we all know that we can claim 10 out of 15 years or 20 years as the case may be. Okay, let us understand this. Option is exercised. Okay, I have exercised the option. I have started claiming. Okay, in one of the years, business profit from non-eligible business, not eligible for 80IA is, let us take 50 lakhs. Business loss or unabsorbed depreciation of eligible business. $20 lakhs. Can this be set off against that 50 lakhs? Can this 20 lakhs be set off against that 50 lakhs?
Yes, sir.
Yes, sir.
Okay, for this they went to court. Assessing officer said this is a separate business. You cannot set it off against this. Court clarified provisions of 80 and 70 are different. 70 is 70 to 80 is carry forward and set off of losses. Set off of losses, carry forward and set off of losses. In that, what we read or what we will be understanding, loss of a business can be set off against any other business except speculation loss, specified business loss. Loss of speculation business only against income from speculation business. Specified business loss only against the income from specified business. Whereas any other business loss can be set off against any income. So don't try to interconnect these two sections and say this business is different, this business is different. Yes, as the class said, assessee can. In the next year, business income from eligible business, okay, let us take 30 lakhs. Deduction under 80 IA or any of these sections will be 10 lakhs. 30 minus 20. This is what the clarification given by the court. Next year, நீங்க again இப்போ வந்து deduction under 80 30 lakhs you cannot claim because the 20 lakhs which I adjusted here should be adjusted and 10 lakhs can only be claimed as deduction. The law is clear that if you have claimed this deduction already, which you have done, in the next year's profit, don't claim 100% deduction, adjust this particular loss and claim the balance only as deduction. Can unabsorbed depreciation of a business of an industrial undertaking eligible under 80IA be set off against income of another non-eligible business? The assessee has incurred loss in eligible business after claiming depreciation. Hence, 80IA is insignificant because there is no profit for which deduction can be claimed. It is thereafter for section 70, whereby assessee is entitled to set off the losses from one source against another source under the same head. Loss from business can be set off against profits from another business except loss of speculation and specified business. The court therefore held that assessee was entitled to the benefit of set off of losses of eligible business against the profits of non-eligible business. Again, a stunning case law. The last three case laws are very important. Eligible business under 80IA. Net profit as per P&L account 50 lakhs. Disallowance as per section 40, various provisions, 40 இருக்கலாம், 43B, 40A2, whatever it is, 10 lakhs. What is the deduction under 80IA if 100% of profits is allowed? Is it 50 lakhs or 60 lakhs? 100% of the profits are allowed as deduction. My profit as per profit and loss account is 50 lakhs. I have disallowed to the extent of 10 lakhs. So now my income is 60 lakhs. My business income as per IT law, as per income tax law, is 60 lakhs. My dear friends, tell me what is the deduction under 80IA if I say 100% of the profits are allowed as deduction? Will you give me 50 lakhs or 60 lakhs as deduction?
50 lakhs, sir.
50 lakhs. Why?
Because that is only the profit.
Profit for income tax purposes, we are only speaking about income tax law.
Okay.
Income for income tax purposes is 60 lakhs. So the question in front of law was, I am disallowing some amount. Can assessee claim deduction for this disallowed amount?
No, sir.
I am disallowing some amount in computation under 30 to 37 or 40 I am disallowing some amount. The question in front of law is, can assessee claim deduction for the disallowed amount also? The answer is yes. Nowhere section 80IA has said that recomputation standards work. 80IA, 80IB, 80IC, 80IE, everything tells 100% of the profits as computed under income tax law. That is all obviously understood. Whenever we say profit, we never regard books of accounts. What is income tax books of account is statement of accounts. 100% of the profits will be allowed. So by interpretation, we understand, even though there are disallowances, that can also be claimed. So the court has said disallowance is revenue neutral. Very nice phrase. Disallowance is revenue neutral. நீ disallow பண்றதுனால, just because you are disallowing, revenue is not going to accrue for the government. Even if you disallow some amount, that will also be eligible for deduction, where the increase in gross total income on account of disallowance of expenditure due to TDS default must be considered for the purpose of deduction under 80IB. If there is absence, assessee is entitled to claim deduction under 80IB in respect of enhanced gross total income as a consequence of disallowance. Disallowance would thus be tax neutral for the assessee on account of profit linked deduction. These are known as profit linked incentive. That 835 AD is known as investment based incentive. So disallowance here is tax neutral.
Sir, I have a doubt here.
Go ahead.
If suppose disallowance because of any timing differences, maybe TDS case, so 30% will be disallowed now and later on that will be allowed. If that 30% is under tax, after the tax holiday period, even in that case,
you cannot claim that debt. So her question is, suppose I am in the 10th year. Now I am adding back 30%. I have claimed the 10 lakhs, 3 lakhs added back. And I claimed the deduction for that. In the next year, she says, I am allowed that 3 lakhs as expenditure. In the next year, I am allowed that 3 lakhs as expenditure because the TDS default is rectified and my profit is identified. Am I not claiming two benefits? I have already claimed 100% deduction for the 3 lakhs that is disallowed also. I have not taxed. Now you are allowing that 3 lakhs and showing a lesser profit. Now I am the 11th year, so the 10-year tax holiday period is over. Can I? The answer is yes. The law has not yet bifurcated like that. This can happen in TDS disallowance and 43B. The law has not yet said in the subsequent year you cannot claim, etc. So as of now, the answer is yes. Am I clear with regard to your question and my?
yes, sir. Thank you, sir.
Sir, I have a doubt.
Yeah.
So any disallowance represents that the law wants to tax that amount due to various provisions, that the law wants to tax the amount.
Yes.
But if the assessee is given the provision to take that also as deduction, then there is no point for that disallowance, no, sir.
Yeah, that's why the wordings itself are so. Disallowance is tax neutral. You are saying that, okay, we always understand which section overrides which section. What is the wordings of section 40, 43B and all? notwithstanding anything contained under 30 to 37. What is the wordings of 80I? The profits of that particular, whenever we say profit as per income tax law. So 40 or 43 does not overrule 80. You compute the profit and that profit is disallowed. This is interpretation of law. You are going to the base fundamental of law and saying, my intention is to tax them. So that's what the assessing officer also said. The purpose of disallowance provisions are to ensure that the assessee has not complied with the specific guidelines. So I want to tax him. But the purpose of 80 is superior to the purpose of 40 and 43. If the law wants to tax it, they would have kept notwithstanding anything contained anywhere. It is taxable. But notwithstanding anything contained under 30 to 37. It overrules only 30 to 37. It doesn't overrule 80. Interpretation.
Okay, sir.
This is one other stunning case law. Unfortunately, now these sections are fading away, so this case laws are not. 2015, 16 or 17, 18 line, the case law ரொம்ப popular, there were questions. What is that? 100% of profits of that business is exempt, especially 80 IB. Whenever we speak about 80 IB, okay, especially 80 IB, it is available for manufacture or production of articles or things. Okay, 100% can be claimed. 100% can be claimed as deduction for manufacture or production of any article or things. You can claim 100% deduction. Interpreted as 100% of profits from manufacture or production. Any other income is taxable. This is interpreted as 100% of profits from manufacture or production. Any other income, interest income, rental income, capital gains, those I will not give deduction. அதுக்கப்புறம் flood of case law started coming. Transport subsidy. Assessee receives transport subsidy. Assessee receives power subsidy. Assessing officer said, இதுக்கெல்லாம் நான் deduction. You cannot claim deduction for these things. This is not whatever you manufacture a product, sell a product, earn profit, that is only exempt. Freight subsidy, transport subsidies and such subsidies, you cannot claim deduction. Pazhasa, there was a case law called Liberty Shoes, which said assessing officer is right. Only from manufacturing or production of any article or thing, if you get profits, that will be eligible for deduction. Otherwise, deduction cannot be claimed. Otherwise, deduction cannot be claimed. This became a bigger issue. Duty drawback, இதெல்லாம் எப்படி deal பண்ணது? Thanks to the Supreme Court intervention in the Meghalaya Steel's case, now these will also qualify, because the Supreme Court said these are also interlinked to your manufacture. Why am I giving you transport subsidy? Why is the government giving you power subsidy? Okay, can transport subsidy, interest subsidy, power subsidy received from government be treated as profit derived from business or undertaking to qualify for deduction under 80B? IB, Supreme Court held transport, interest, power from government were revenue receipt which were reimbursed to the assessee for elements of cost relating to manufacture. The basic purpose of giving this itself is to match your cost of manufacture. Therefore, there is a direct nexus between the profit of the undertaking or reimbursement of subsidy. The subsidies were only in order of reimbursement, wholly or partially the cost involved. Accordingly, these subsidies qualify for deduction under 80IB. Thanks to this case law, but for this case law, people were erratically taxing everything. This particular case law gave the biggest relief for the assessee that no, these things will also qualify for deduction. Having said this, there is one thing which is still pending. Duty drawback. What is duty drawback? I export goods for at the time of manufacturing, I would have paid GST or something. Since I am bringing foreign currency into India, they are giving me, the law still says, அதாவது ஒரு judgment, Meghalaya Steels has not overruled that. So go back to the Liberty Shoes case, where they said this has nothing to do with manufacture. Duty drawback manufacture பண்றதுக்கா? No, it is for exporting goods. That was not given to you for manufacturing purposes. It is given only for export purposes. So, deduction should not be claimed. Duty drawback receipts cannot be said to be profit derived from the business of industrial undertaking for the computation of deduction under section 80IB. This is nothing to do with manufacture. So that alone still taxable. All other subsidies which are for the purpose promoting manufacture will enjoy the deduction. These four case laws, please remember. Okay, Sunil Vishwanath Tiwari, where even disallowed amount will be eligible for deduction. Meghalaya Steels, where they spoke about subsidies. RK Pharma, where only duty drawback. And Swarnagiri is the one which tells us you can claim the specified, non-eligible to eligible business losses.
Sir, one doubt.
Yeah.
We know that in section 28, subsidy is taken as income unless it is given specifically for an asset. Can we also use that to interpret that it is to be taken?
Yes. I told you these are, the judgment comes now, so you can imagine when the case would have happened. At that time, section 28 did not have subsidy, no ICDS, nothing.
Okay, sir.
So that's why judgment is not touching upon that part. No?
Okay, sir.
Two other procedural nature of case laws. You said 10 years of exemption. 10 initial years. 80IB fulla initial years. Only 80IA, 10 out of first 15, 10 out of first 20. 80IB is full of first 5 years 100%, next 5 years 30% or 25% as the case may be. From which year? Year of trial run, year of commercial production. For which the court answered, normally year of commercial production, no doubt about it. Normally it is from the year of commercial production. But if you had a trial run, understand this case, if you had a trial run and the product manufactured and the product are sold, if you have a trial run, products are manufactured and those products are sold, that means your commercial production has started. In trial run, you can do the trial run, the product produced, you are internally testing it for quality, etc. Fine. But the product produced is sold. That means you have passed the commercial test also. So in that case, from the year of trial run, I will compute 10 years. From the year of trial run, I will compute 10 years. It commences from the year of commercial production. It normally computes it's from the year of commercial production. However, where the products manufactured or trial run are sold irrespective of the quantum of sale, its commercial branding, still the commencement criteria is fulfilled. Hence, from the year of trial run, the period will commence. You should not sell the products. If you sell the product, that means that itself is a proof that your commercial production has begun.
So here again, it is the option of the assessee, no, sir?
Yes, yes. You should be careful. Yeah. For personal experience, okay, purely personal, okay. Previously, there was a section called 10B. Units located in SEZ, 10 years exemption. First 10 years exemption. Assessee started the company, incorporation. Okay, 1st March. Let's, for example, take 2010. Okay. Commenced business. First revenue transaction, that is a revenue started to come into the company from May 2011. Assessee claimed NB from 11-12 financial year 11-12 for 10 years. This is the facts of the case. Okay. சும்மா இருந்திருக்கலாம். I was casually, I was not even the auditor of that company. I was an auditor of one of the group companies when I was in practice. Casually, they came to me for something. I said, you are under problem. When I read section 10B, it doesn't have the words from the year of commercial transaction. It just first 10 years. So your deduction will start from 10-11 and not from 11-12 because you have incorporated. Okay, you have incorporated as on 1st March 2010. So your first year ends on 31st March 2010. So you are on 9-10, for example, if I take it as 11. I told you, for you it is from 10-11 and not 11-12. Pora the column. After 2 months, the company received a notice from the income tax department stating, for example, they are claiming from 11-12 for 10 years and the 10th year is 2021. For 2021, deduction cannot be claimed. This is the notice. Saying your 10 years is already over. You have wrongly claimed this deduction. So we are reversing the deduction and taxing it along with penalty. That company people thought that it is me who told the income tax department. எனக்கு அந்த ஆபீசருக்கும் எனக்கும் income tax department is the rarest thing I go. I am only away from the department, away from the only I give my opinions. But எவ்வளவு சொன்னாலும் I am unable to convince them that I have no involvement. சார் நீங்க எங்கிட்ட சொல்லதோடு நிறுத்திருக்கலாம் சார். Why will I go and tell somebody? But I found this man. No, sir. Our auditor didn't tell. Only you pointed out. From the day you pointed out, within 2 months, notice came. What can I do? I have no role to play. I was trying to explain them that I have no role to play in that. But still, you are wrong. That's what is my opinion to them. Okay, so in the Mari, so whenever I see this case law, I immediately remember one of my suggestions, which became a very big problem. So in that year, what would have happened? Trial run only, no commercial production we haven't started. Commencement of business certificate we have not started. So you did not claim exemption. Exemption is only from commencement of business. No. Trial run by itself proves you are commercially ready. So from that year you should have. Last case, of course, now this cannot be a case law because this cannot be the first year. The examination you are writing cannot be the first year. So obviously the section should be dynamic. The section is fading away. So that's why I'm saying these type of sections, case laws are only for your understanding and not for, I don't even know whether it is getting removed in the next materials which they are releasing, but as of now I'm keeping it. Last case, Praveen Soni. Okay, what happened? Assessee failed to claim 80 IB deduction because he is unaware that such a deduction can be claimed. Yarnalan will not speak. Okay, assessee is unaware that such a deduction can be claimed. After 4 years, he comes to aware of that section. Can he claim from the 5th year? Assessing officer said, when you are foregone, you are foregone. That's all. But the court had no. If he wants to claim from the 5th year, allow it. For the rest of the period, allowed. The deduction under 80 IB should be allowed to the assessee for the remaining years up to the period for which he is entitled to, provided all the conditions are fulfilled. Just because he has not claimed it in the initial year doesn't mean he can never claim that. Okay, in this again I am saying Archive Pharma, Meghalaya Steels, both are related case laws. Okay, Sunil Vishwanathan and Swarnagiri are the important case laws which you have to remember. Friends, the questions I am going to work out. Past examination questions. Past examination questions. I am taking this precaution for making you understand. The examination question might have been 2017 or 2020, like that. Because when I now say this is the first year of operation, you will immediately say, sir, this year you cannot claim, sir. In that year, the question has come. I have reframed it for your assessment year. Now I cannot work out for assessment year 17-18. But there are some interesting things to understand. That's why I have picked those questions, reframed it for your So don't think that I know current year you cannot claim this, but still I am having these questions because you need to understand certain aspects. VKS Limited is engaged in developing, operating and maintaining infrastructure facility ATIA. The company is also engaged in producing cement. Business of infrastructure facility was commenced in 1920. 1920 exemption கிடையாது. Your 17 ஓட over. Question came in that year, but I have reframed it for the current year. During the three preceding financial years, profits of the two business are 1920, 2021, 21-22, which is your current year, 75 lakhs, including freight subsidy of 10 lakhs under the scheme of central government. Further information. Cement manufacturing transferred cement of certain quantity for an aggregate price of 20 lakhs. Similar quantity was sold outside for 25 lakhs. Profit of infrastructure facility business has been arrived at after charging purchase of consumable stores amounting to 10 lakhs from RR Limited, a subsidiary company of the present company, as against the FMB of 7 lakhs. Compute the amount admissible as deduction under ATIA. Give working notes and reasons for the context of statutory provision for each aspect. Read through. The business of infrastructure facility was commenced in the financial year 1920. Assessee should not opt for ATIA in 1920 as it is loss-making year. ATIA can be claimed for 10 consecutive years out of first 15 years. Since 1920 is a loss-making year, assessee can start opting from 2021. This is what is popularly known as tax planning. So what happens? Profit of cement division is 120 lakhs. Less loss of infrastructure undertaking. This can be set off against income from another business. $20 lakhs is the taxable income for financial year 1920. Profit of infrastructure division 60. Profit from cement division 140. Gross total income deduction under section 80 IA. 100% of profits of infra division. Taxable income. Now let us come to our year and start computing. That is what is more important for us. These are just the working notes. Information is relevant for our year. Net profit as per P&L account. Net profit as per P&L account 75 lakhs. Net profit as per P&L account of infrastructure division 75 lakhs. Pride adjustments. Freight subsidy according to Meghalaya Steel's case, it is held any subsidy which is directly related to manufacture or production will be eligible for deduction under 80IA. Hence, no adjustment.
Sir, I have a doubt. If
Go
the
ahead.
subsidy is given for a specific asset, will I include it in the deduction?
That should be adjusted with the cost of the asset. Section 32 la தான் compute பண்ணிடணும். First PGBP பிரகாரம் தான் இதை compute பண்ணணும்.
Okay, sir.
The revenue subsidies are only spoken about in Meghalaya Steel's case, not capital subsidies.
Okay, sir.
Right. Now, in all the provisions, 35 AD, all through 80IA, Section 10A, all through transfer pricing provisions, we are going to see a particular words called inter-unit transfer should be at arm's length price, fair market value. Shall I repeat? Inter-unit transfer should be at arm's length price, fair market value, etc. Ipo, we will understand the reason and then read the adjustment. Cement division I have, and I have roads, infrastructure division. So, என்னுடைய cement da I am going to transfer, which will be used for laying roads. And whatever profit I am showing for laying roads is going to be allowed as deduction, no tax. Whatever profit I show in my cement division is going to be taxable. So, what will I technically do? I will show low profit in my cement division and high profit in my infrastructure division. How will I do? By transferring at cost. Cement division will transfer it at cost. So my manufacturing cost comes to 100 rupees. If I am selling to an external party, I would have sold for 150 rupees. This is my own infrastructure company. So I transfer it for 100 rupees or 110 rupees. When I make to an external person, I make a profit of 50 lakhs or 50 rupees, which is taxable. Here, by transferring it to my own division, which enjoys a deduction, what I am trying to do, I am keeping my profit low. And there the profit can be high. Still it is my profit only. So the law uses the term called inter-unit transfer. One unit to another unit, eligible unit to a non-eligible unit or vice versa, can only be at fair market value. In transfer pricing, we will read more about it, at arm's length price. Okay, right? Look at the wordings. Cement division, cement manufacturing, transferred cement of an aggregate quantity, aggregate price being 20 lakhs. Had I sold it to an external customer, I would have sold it for 25 lakhs. 5 lakhs, I am understating my profit in the cement division and overstating it in infrastructure division. inter-unit transfer should be at market price. Where it is not at market price, adjustment needs to be made. In the given case, cement purchased is for 20 lakhs, but the market rate is 25 lakhs. So what I do, minus 5 lakhs. My purchase price should have been purchases account debit to party 25 lakhs. But unfortunately, purchase account, I have put 20 lakhs. I am overstating, understating my expenses. No. It is wrong. I will tax it there. You reduce it here. Profit of infrastructure facility has been arrived at after charging purchase of consumable stores amounting to 10 lakhs from a subsidiary company, the fair market value being 7 lakhs. Which provision are we speaking about? Which provision are we speaking about? Come on, friends.
Transfer of goods.
40A subsection 2,
Payment to
payment
relatives.
to relatives. I have purchased goods from my subsidiary company for 10 lakhs, whereas the fair market value is 7 lakhs. கொஞ்சம் மாத்தினா phrase மறந்து போயிடுமா? எல்லா questionலயும் 48 48.3 will be somehow touched upon. According to section 40A subsection 2, payment to relatives should be at fair market value. Where it is in excess of FMV, such excess shall be disallowed. So in this case, the excess is 3 lakhs. Let's start. So this is one inter-unit transfer. That's what I want to stress upon. Second question. Again, that clarification which I gave you, because developing SEZ, what is the nature of income you will get? Rental income, royalty income, and any associated income also. Maintenance income, parking income are also associated with that SEZ, where the court, that's a very, 5 years back, it's a very famous case law. At that time, this question appeared, where the court said, yes, you should provide deduction for that also, because that is also profit accruing from developing that SEZ. ABC Limited, a developer, is engaged in business of developing special economic zone notified on or after 1st April 2005 under the SEZ Act. It was established in 1516. It had established in the previous year. Sorry, it is repeated. It had exercised its option for claiming deduction from 1819. It received the following incomes during your previous year. Income from maintenance of SEZ 50 lakh 40,000. Income from lease rent from letting out building along with other amenities. Interest received from bank deposit from the refundable security deposit received from lessees. Calculate the amount of deduction for 22-23. On 1st April 22, it transfers the operation and maintenance of SEZ to another company called DEF Limited. Now, DEF Limited wants to claim a deduction under 80 IAB in respect of income derived from such maintenance, which was available for ABC. Comment whether the contention of DEF is valid in law. Can you answer the second question first?
Valid, sir.
Why?
Yes, sir. Provisions of the transferor
Provisions of the transferee company will apply to the provisions of the transferor company will apply to the transferee company also, as if the event has not happened. So for the remaining period of years, 10 years to claim, 5 years is over. For the remaining 5 years, DEF can claim. Okay, now This is the right format to work. It is a deduction and not an exemption. You should find out the gross total income and provide the deduction.
The interest from deposits, even though it is for the specifically mentioned for these purposes, won't that be taken into consideration?
You mean to say whether income from deposit, can I take it as business income? Interest. Yeah.
It is a purpose.
Yeah, I'm coming to that. Unless the purpose is given. We have some case laws, Rama Multi Tech, where share application money, it is mandatory to keep it invested. K and Co, it is mandatory to provide to keep deposit for providing bank guarantee. Unless it is mandatory, it is only known as surplus or it is only known as allied activity. So you should not take it as business or profession. You should take it as other sources.
Okay, thanks.
In the past 5 years, 10 attempts, only these two questions have come. This question came importance because of Meghalaya steels, and they took the opportunity of inter-unit transfer also. This question came because in that year this circular came, judgment and circular came, that even amenities, extra amenities will be taken as, otherwise they were taxing it as IFOS and not providing deduction. That year this clarification came. Otherwise, when we do assessment of firm and companies, some wordings will be there. 80IB can be claimed to the extent of 30%, 100%. Please don't give much importance to 80I because it is sunset provision. Write a short notes that is more than sufficient for you to pass through that. Please don't give much importance. I mean it from the student's perspective. But the most important deduction, business oriented deduction, is this 80JJAA. Is this 80JJAA deduction in respect of new employees? Deduction in respect of new employees. What is that? For promoting employment, it is being given to business associates. Starting very simply, it says 30% of additional employee cost will be allowed as deduction. 30% of additional employee cost will be allowed as deduction. Seemingly simple. Anna, the conditions have made it either complicated or difficult. First, understand, this year I employed 5 people. Can I claim means there is a one big question mark. How many people resigned? Why I am telling this is, what is the intention of the law? To promote employment. You had 100 employees, 10 of them resigned, 5 of them joined. You are not promoting employment, boss. You are not promoting employment. The number of employees as on 31/3/2022 should be more than the number of employees as on 31/3/21, only for that excess I will allow this deduction. The number of employees as on 31/3/22 should be more than the number of employees where there is no increase in the number of employees from the total number of employees employed in the last preceding year, or emoluments are paid otherwise than well, then deduction will not. So please remember, I want the number of employees to be more. In the first condition, total number of employees. Okay, I employed in the current year. What are all the conditions? Eligible employees means their remuneration should not exceed 25,000 per month. You appointed a CEO for 1 crore salary per annum. I am not looking at one person, 1 crore. I am looking at promoting employment. Small, Maria, you, Zoho, many software companies. For all of us now, the greatest inspiration is Freshworks, Ganesh Matrabhudam. Okay, so coming back, so I want the lower cadre, that is the first employments to be more. So employee salary should not be more than 25,000 per month. 2, employee should be covered under PF. 3, employee should have worked for 240 days or more. Seasonal industry 150 days, but leave that, 240 days or more. You should have employed him on or before 31st August. Don't employ him in the month of March and claim deduction. On or before 31st of August. And pay his remuneration only through approved modes. Then I will consider him as an eligible employee. Whatever salary you are paying to him, on that 30% you can claim. Once more, available for all assessees who are coming under tax audit net, 30% of additional employee cost means total emoluments paid or payable to additional employees. There should be a net increase. Additional employees does not include, negative definition, employees whose salary is more than 25,000 per month. Employees whose salary is more than 25,000 per month. Employees not covered under PF. PF is borne by the government. Okay. Or who is not participating in RPF, who has been employed for less than 240 days. So positively, if you want to see, less than 25,000, more than 240 days covered under PF. Emolument should be paid by account payee check or draft or any other approved modes. One greatest benefit is first year all employees become new employees. In case of first year of a new business, then emoluments paid to employees during the shall be, okay, all the employees become new employees. Because last year 0, all the employees will be new employees, other conditions should be fulfilled. Read through. Section 80M, intercorporate dividend. Okay, this was introduced in the last year. Okay, this is to avoid what is popularly known as cascading effect of dividend. Here is a company, it is only for companies. This is, I receive dividend, that company would have paid the tax. That company would have paid the tax. Okay, after that only they are distributing the dividend. Be it my subsidiary or whoever, they would have paid tax. I have received that dividend. Taken it to my credit side of P&L. Got my profit. Now I am declaring dividend. That company has already paid tax. I will also pay tax. We who are shareholders will also pay tax. Cascading effect. In order to stop that, they said, if you are declaring dividend, let the ultimate person pay. You need not pay. Remember, I received dividend, that company would have paid tax, forget it. I am declaring dividend now. Company, that declaring dividend minus dividend received. So this deduction is for intercorporate dividend. The gross total income includes dividend from either domestic company or foreign company or business trust. Quantum of deduction, actual dividend received or dividend distributed before 1 month prior to, that is before 30th September, whichever is less. Okay, about this I will again look into in assessment of companies. Now for 80 JJAA question. Vikram commenced the business. He employed 350 new employees during 21-22. 75 regular employees for monthly remuneration of 24,000 qualifying employees. 125 regular employees from 1st May, monthly emoluments 26,000 not qualifying employees. 50 casual employees. Casual employees means PF will not be covered, non-qualifying. 100 regular employees from 1st September will not qualify, less than 240 days. Regular employees qualify for RPF, whereas casual employees do not. Further, out of the regular employees, 100 employees do not qualify by the term workman. No, not necessary. They need not be workmen, even otherwise. I have my own conditions. So let me not look into Industrial Disputes Act. The question is compute deduction under 80JJ. 64,80,000. Let's do ATM later. When we do assessment of companies, I'll repeat it. Don't worry.
Sir, I have a doubt, sir.
Go ahead, Anthony.
Sir, in case uh, in this current year, like two employees left the company, and we have got three new employees. So there is one
Only one
additional employee.
employee will be an eligible employee.
Okay, sir. So that calculation I doubt.
The one other unit which is important to understand before progressing forward is alternative minimum tax, AMT. AMT is something for non-corporate assessees. For companies, there is something called MAT 115JB. For non-companies, it is 115JC. Okay, alternative minimum tax. But before going into that, I want you to understand section 10AA, again sunset provision only, but it is important to understand. Section 10AA provides exemption. 10AA provides exemption for units located in SEZ. If you are a developer of SEZ, IAB, units located in SEZ is coming under 10AA. Why they are giving exemption? Because they are bringing foreign currency to India. So I want to give Dr. Manmohan Singh's period. Okay. I want to give them the benefit of contributing to the nation by bringing foreign currency. So I said export profit from export turnover is exempt. What is exempt? Export profit from export turnover. இப்போ என்ன problem? What is export turnover? Export turnover does not mean whatever you export. Why am I giving this exemption? Because you are bringing in foreign currency to me. Export turnover means money brought into India in convertible foreign exchange within September 30th, 6 months from the end of the financial year, or sometimes RBI will permit you to hold the money there itself. Why? To bring in and again pay back. You hold it there itself. Repeating, export turnover means not the amount of goods you have exported, quantum of goods you have exported or volume. It is money brought into India in convertible foreign exchange before 30th September 2022 for the year ending 31st March 2022, or money retained outside India with the approval of RBI. If this is export turnover, then export profit is equal to proportionate total profit into export turnover by total turnover. Total profit into ET by TT. Quantum of exemption, first 5 years 100%, next 5 years 50%, and last 5 years transfer it to a special reserve account, export profit reserve account, you will get 50%. When you are doing amalgamation and all, you would have read statutory reserves has to be as it is maintained. In purchase method, you pass an entry amalgamation adjustment account debit to statutory. This is one of the statutory reserves. If you are in the last 5 years, first 5 years 100%, next 5 years 100%, the last 5 years is optional. Pay tax, or if you want to, you don't give it as dividend and all, transfer it to an export profit reserve account. read through the theory of 10AA. This is essential to progress to AMT, that's why. So, there were some entities, leave the corporate, non-corporate entities, understand? There were non-corporate entities which are making profits as per books of accounts, which were making profits as per books of accounts, but not paying taxes because they were able to claim 10AA or deduction under section 80I or deduction under section 35AD. In books of accounts, they were making profit. They were enjoying the benefit. But when it comes to income tax adjustment statement, which is books of accounts for income tax purposes, the profits are very low or no profits or only losses because they were able to claim these benefits. So the lawmakers felt these people are making profits but not contributing to the exchequer. Make them contribute a small amount. Alternative minimum tax, AMT, alternative minimum tax. AMT is computed on what is popularly known as adjusted total income. Okay. AMT is an extension of MAT provision. We shall see in assessment. Non-corporate assessees who enjoy book profit were not paying taxes or paying lesser taxes due to the benefit of exemption under 10AA or deductions. In order to make them participate, these provisions were introduced. Okay, right? Where AMT is applicable, books has to be honest person. Alternative minimum tax provisions are applicable for LLP, firms, individuals, etc., whose adjusted total income. So here comes a concept called adjusted total income. AMT is on adjusted total income. Okay, what is adjusted total income? Total income after providing for all allowances, expenditure, exemptions and deductions. Add exemption under 10AA, deduction under 80I, basically 80I, expenditure under 35AD. Less depreciation on assets which are claimed under 35AD. Because in 35 AD, I claim the capital expenditure as deduction. Now you are adding back, reduce the depreciation. Assessee is liable to pay either normal tax or 18.5% of ATI, adjusted total income, whichever is higher. Either normal tax or 18.5% of adjusted total income, whichever is higher. If the idupati, we will do it in international taxation. Read the theory once, just a moment. Question number 6. Don't worry about question number 4 and 5. I will do it in assessment of companies where it is more relevant for you. More relevant for you. So assessment of companies, I will take up that question and answer you. Now, question number 6. A sole proprietor commenced the business which qualifies for deduction under 35A. The total investment made is 1 crore 100 lakhs at 15%. The sole proprietor earned an income before providing deduction under 35 AD 80 lakhs. This apart, he has IFOS of 25 lakhs. Compute tax. Read it. First, step 1 will be computation of total income as per normal provisions, friends. Loss from specified business can be carried forward and set off only against the income from specified business. My dear friends, I will keep repeating this in the classroom. Whenever you claim any of these three things, you should remember to work out AMT also. Repeating, whenever you claim 10 AA, 35 AD or 80I, whenever you claim 10 AA, 35 AD or 80I, non-corporate associates, ensure to work out AMT also. The question is talking about AMT. Whenever you claim 10 AA, 35 AD or 80I, unless the question itself says ignore AMT, you should also work out AMT. Computation of adjusted total income. For this, the starting point is total income. Total income computed as per normal provisions after providing all expenditures, deductions, and exemptions. Total, this is the starting point for adjusted total income computation. This is the starting point for ATI computation. What is the starting point? Total income after providing for all expenditures, deductions, and exemptions. This is the starting point for AMT computations. ATI, adjusted total income computation. And in this question, 10 AA is not there, ATIs are not there. Expenditure under 35 AD. I claimed 100 lakhs as expenditure, 1 crore as expenditure. Less depreciation at the rate of 15% on plant and machinery. The question says it is plant and machinery 15% block. Okay, on expenditure claimed. Computation of tax particulars, normal AMT or ATI. Income is 25 lakhs as per normal provision, whereas ATI provision, adjusted total income, 1 crore 10 lakhs. Tax on income. Please understand this minus 10 lakhs into 30% plus 1,12,500. 15 lakhs into 30% plus 1,12,500. 15 lakhs into 30% plus 1,12,500. AMT at the rate of 18.5% on adjusted total income. AMT at the rate of 18.5% on adjusted total income. Surcharge at the rate of 15%. Inga varadu surcharge because income has not exceeded 50 lakhs. Whereas here, income has exceeded 1 crore, so surcharge will be 15%. Up to this takedown. A non-corporate assessee is liable to pay either normal tax or 18.5% of ATI, whichever is higher. Where tax is paid as per ATI, or actually where AMT is paid, then difference between AMT and normal tax can be carried forward as tax credit 115 JD. So in this case, this difference, okay, can be carried forward as tax credit. This can be adjusted against normal tax payable in the future years. Maximum period of carry forward 15 AYs.
So the provision is for alternative minimum tax, but the assessee is supposed to pay normal tax or AMT, whichever is higher. So what is the minimum here, sir?
Ida,
No, sir, I'm saying it's called alternative minimum tax, but we are ending up paying whichever is higher.
No, had I not provided that deduction, my normal tax would have been much higher. I understand what you are saying. Okay, I am also against this section. I'm completely against this section. 115 JB or I'll speak about it.
Okay, sir.
JD is like a GST credit input mechanism. Difference between 24,33,860 and 5,85,000, and be carried forward and adjusted in the year in which you are paying normal tax. If you are continuing to pay AMT, you cannot. And maximum 15 assessment years. I understand Ananya's question. What is the point in giving an exemption and pulling it off? Actually, this is only should be known as AMT. This is when it is higher, how can you call it as minimum? That's what his question is. We'll speak about it. When will AMT be computed? If any of these three things are there, exemption under 10AA, deduction under section 35 AD, deduction under 80Is and expenditure under 35 AD. Remember, AMT will be computed. Remember, AMT will be computed. Am I clear? Where are we in our journey? I want the class to understand. We have completed the part 1 of our journey. PGBP, capital gains, IFOS, business-oriented deductions. In this, we did some house property also. House property, we will keep doing. This has bridged us to cross to the next level. From tomorrow, it is all assessment of entities. From tomorrow. Starting with firm, my travel is going to be firm, companies, a charitable trust, cooperative societies, individuals. Repeating, firm, there is something known as pass-through entities which we will see, and then companies, charitable trust, cooperative societies, and individuals. Part B, which is going to be consolidation of whatever we have done, along with additional provisions. We are going to become further more clear about PGBP, especially PGBP and capital gains. Further confident about PGBP. So I want the class people to understand something, to browse through PGBP today. Just browse through so that when we go to the assessments, you will find it more interesting to work. More you will enjoy and work. Okay. PGBP, capital gains, sometimes salaries, deductions, TDS, few areas of non-resident. I always try to give 1 or 2 extra adjustments, own questions. Assessment, I have always confined myself to past examination questions, RTPs, MTPs, everything. Because I want you to understand what type of questions appear again and again and again, so that you will not miss it at all. You will feel more confident. When I put a dot on assessment, you will be absolutely confident with some of the chapters. As of now, I am not saying what it is, but from tomorrow, part B of our discussion, assessment of various entities commence. And tomorrow we are starting with firm. For those who are coming in physical, we'll meet in the institute, others in the online platform, 6 a.m. tomorrow morning. All the best, friends.
Thank you.